The question comes up is why would it take even someone like Warren Buffett to find one good idea approximately every 5 years?
Hi Team Value, JJ here, welcome back. Well, today I'm going to react to a very recent Q&A session with Mohnish Pabrai he had with Columbia Business School students. He says Columbia's hallowed ground, and it is because Ben Graham taught there. Warren Buffett himself went there. There have been other great value investors that have taught there. Pabrai is talking in this Q&A about how even these great investors have very few excellent ideas. Even Warren Buffett, the percentage of great ideas, great investments over time haven't been that many, but the ones that have been incredible investments compounding over time, and they've kept them. We can have many mistakes over time. We just have to find those great investments, realize that they are great investments, and hold on to them. So he talks about that, and I'll react to it. So let's get into it.
You guys might have seen in Buffett's letter this year, that last year actually, that he had mentioned that basically 12 ideas or 12 investments that he made for Berkshire over 58 years were responsible for most of the outcome. These 12 decisions, one of them might have been hiring Ajit Jain, the Coke investment and Amex and Cap Cities and so on, and Seascandy and so on. So one of the questions that comes up is, I think over 58 years, my estimate is that Buffett probably made at least 300 or 400 important decisions and investing decisions. And the hit rate, if you will, was basically like 4%, 3 or 4%. And it's a 3 or 4% hit rate for Warren Buffett, which doesn't leave a lot of hope for the rest of us mere mortals. And so the question comes up is why would it take even someone like Warren Buffett to find one good idea approximately every 5 years? And I thought about that, and I think that the 5-year period might actually be almost like a law of investing, law of value investing. And the reason is that for us to get to a conviction level on a particular investment or idea that's going to move the needle means that we have a differentiated view from most of the market. Because if our view was similar to the market, then that would be reflected in the market, and there wouldn't be supernormal results possible. So it's a kind of a, let's say, a differentiated view that causes the outsized returns. And I think the differentiated views, they fall into two categories. They fall into categories where we were delusional, which means that we thought that we had a differentiated view, but in reality we were wrong. So we make the investment, thinking, oh yeah, I've figured out something the market hasn't, etc., and this is going to be great, and it doesn't work. So those don't count in his 12 decisions in 58 years, but he may have had probably 1 or 2 dozen of those types of situations where he had very strong conviction, which ended up not being accurate. And the second is that you're actually right on the money, where you got a differentiated view, caused outsized returns.
I think this is a really interesting point, and I've been thinking about this quite a lot lately. He's saying here that you don't actually make the right decisions that shoot the lights out, as Terry Smith would say, very often. So, over 5 years, you definitely make more than one decision every 5 years. But what he's saying here, and what Buffett said, is that so few of those are actually going to be the right in terms of being a supernormal, as he said, decisions, like not very often. So that means that, so you have 10 investments, or at the moment I have more than that. My Patreon members know that I have more. They know what I've got there, and I'll talk more about one that I've just made over there in Patreon. If you want to join, I'll put a link in the description. But what he's saying here is that you might make the analysis and know quite a bit about the company, and then you make an investment, and your conviction grows over time, and maybe it turns into a compounder as you thought. So you have more and more conviction as time goes by, and you keep it for a very long time, as Buffett has with some of those investments and Munger. But other ones you might sell because it didn't work out, and there will be mistakes. Investing is forgiving from that point of view, that you can make lots of mistakes, and you will if you make 10 investments that maybe only a few of those are going to be okay, worth keeping over the long term, unless it's a more traditional value play, like a Ben Graham type of investment where you're waiting for it to get to fair value and then you sell. But those long-term compounders that are held for a long time, maybe the decision's not right in the first place, and that's okay to have a high error rate, or it may be mediocre rather than great over time, and there'll only be a few that are really good. Be pulling the weeds and watering the flowers, so to speak. Now, if you're getting value out of this Mohnish Pabrai episode so far, I'd really appreciate it if you did hit that like button. It really does help the algorithm to spread it to more people. It really does work. So I'd appreciate it if you did that. Thank you.
And I think one of the things that Charlie Munger used to say was that if they had not been learning machines over that 58-year period, then their record would be a shadow of what it actually was. In fact, nobody would even talk about them. So basically, the knowledge base and information and understanding about the way the world works that they started out with 58 years ago was relatively small and simple versus what they figured out over the years. So to give you an example, Warren made an investment in Burlington Northern Railway. And first he made an investment in the stock where he bought, some portion of the company. And then I think maybe a few years after that, he made an offer to buy the whole company. And they mentioned a few times that they were always negative on railroads. For most of their career, they said that railroads were actually a poor investment. They were very regulated, unionized, and a lot of inefficiencies. But what happened is that they noticed a few things which caused them to change their mind. So one of the things that happened is the railroads over time redid the bridges. They had thousands of bridges. They redid the bridges one by one. So it allowed double stack cars to go underneath them. So instead of having single stack, you could do double stack. And the second is that, with diesel costs and all of that, and the railroad also started becoming more efficient in terms of how they were running, the level of employment, the length of the trains, and so on. So basically a tipping point came where it became much better alternative to the best alternative, which would have been trucks. And trucks, of course, we have a lot of labor and stuff. They can go anywhere and they can go short distances. But anytime you had to go long distances, then the railroads had an advantage. Both Warren and Charlie said that they were actually late to the party. The guy who runs Bill Gates' money at Cascade Investments actually figured it out a few years before them. And I think even Bill Ackman may have figured it out a few years before them. So the thing is that to go through this learning about railroads, for example, where you have a view and then you go through a change in that view, that doesn't happen overnight. That takes a lot of drill down to get to a conviction level and such. So when you look at a 5-year time frame, it could have easily taken them 2 or 3 months or more to really get their arms around railroads. So first they would have had to made a decision that there is meat on this bone, so it's worth studying. And it's worth looking at maybe destroying one of our best loved ideas, which is railroads are stupid. And then you go into the rabbit hole of railroads, which might be 2, 3, 4 months or something. And there's also a lot of rabbit holes you go down, which end up being dry wells, which is you go down the rabbit hole and there is no meat on the bone. And there is no differentiated view, but the time is gone. So basically, if you think about these 3-month type deep dives, in a 5-year period, you can do 20 of them if you had something to do every 3 months. And, maybe 1 out of 3 that you think is great actually turns out to be great. So if you actually did 20, you might have 3 or 4 that look interesting, and then 1 is actually a good idea.
It's a really good example there of the railroads, I think, where over time their conviction grew and they knew more about the industry, and it changed over time as well. So they, as he said, they didn't think it was a good idea to begin with, but they did a few months of research, a few weeks, a few months. When we get interested in an idea and we might buy a position in that idea, or we might put it on the watch list for later if it's not the right price, or we might take a starter position, however, whatever strategy that you use, whatever approach that you use to investing, and conviction could grow over time. But a lot of ideas that we might have even bought fall by the wayside. They turn out not to be good. But that one, thinking about it, it's the one that it's actually recognizing that it's the one to keep, that can keep compounding for 5 years, 10 years, 20 years. That could be a 10x or 100x over time if you started off with a small cap and it keeps on growing with a long runway for growth. As Chuck Akra says, he's looking for those long runways for growth and good management. So, thinking about it, if you have these companies that that are over time, that, compound over time, that get better over time, it does make sense that there won't be very many of them at all, even from the ones that you choose. So, the way that he works and the way that I've started to work more and more is that to filter the ideas down, to look at the 13 F's of really great investors and investors that you respect. It narrows it down to a small pool, and then you might go down that rabbit hole, as he says, of working out why they invested in that. And some will be dead ends, rabbit holes with dead ends, and the very few that you might choose, but some of those might not work out either, because people can be wrong, investors can be wrong. One idea of every 5 years just does not seem like very many, but over the decades, it could be a good solid portfolio. And if you do look at, say, Chuck Akra's portfolio, there's not that many ideas that have been built up over decades, but they're all great compounding companies. The point being that very few ideas are going to work out, and that's okay, as long as those ones that we keep for a long time, because it's easy to sell them as well at the first sign of trouble. So having that conviction, starting with a lot of research and keeping on learning more about each industry, each company, obviously, I think really important. Now, I've mentioned in this episode how I've got more than 10 stock positions at the moment in my portfolio. Hopefully some of those will work out to be long-term, very long-term compounders, and probably from what Pabrai said here, some of them will be mistakes, of course, but hopefully over time can build up a museum of long-term compounders. That would be the ultimate goal, like, say, Chuck Akra. So if you want to check those out, there's some discussion over there about positions and companies. It's not investment advice at all, just what I'm doing. I'll leave the link in the description and see you over there. Now, if you're new here, you might not have seen quite a few of the other Mohnish Pabrai episodes that I've made before. So I'm going to put 2 links here to previous episodes. Go and see one of those now if you want to. And thanks to everybody for watching or listening, and I'll see you in the next one.